Hi, this Saturday we have two interesting webinars lined up for you. At 10 a.m. we have The Age of Asset Allocation, and at 12 p.m. we have From Miles Away to Kodeeswari, exclusively for NRI women. The registration link are in the description. Do register and join the webinar.
Why should you seek safety now? We are at an all-time high in the Nifty, but we are not anywhere near an all-time high as far as the broader market is concerned. In fact, several microcap and SME companies are significantly below their all-time highs and even their 52-week highs, because probably in many of these companies, the all-time highs were actually hit before 52 weeks. In businesses, when valuations are diverging from the broader market trend, as an investor, we need to look closer. The Nifty is at an all-time high, the Sensex is at an all-time high, but your portfolio is nowhere near an all-time high. In fact, a lot of stocks in your portfolio could be looking weak. When I look at companies outside the top 500 by market cap, I see tremendous weakness, and I see this weakness growing as the market capitalization reduces. Essentially, this seems to be a market where capital has got over concentrated within the top 500 companies, and this has happened more in the last 1 year. And this over concentration has actually happened more within the 400 companies of the top 500. The top 100 is not where I see this concentration risk with respect to capital. I see it more between 101 and 500. And when you go below 500, the picture is definitely not looking good. So as an investor, we must realize that we are heading into a situation where liquidity in trading is fast reducing. What does this mean to us? In the event of our needing liquidity in the future, it would become extremely difficult to get out without high impact cost in certain parts of the market. You need to evaluate whether the stocks you own or the funds you own, which invested indirectly for you in stocks, have enough liquidity in their trading or in their portfolio. The fund needs liquidity in the portfolio, the stock needs liquidity in the trading. If a fund does not have liquidity in a portfolio, then you must look whether the stocks owned by the fund have adequate liquidity in the market. You must be able to sell. The reason I am sounding cautious and trying to raise an alarm is this liquidity in the market trading is not giving me comfort. In fact, it is giving me acute discomfort. So, if you're owning companies which lack that liquidity, I'm not against it, but you must be sure that you don't need liquidity for a long time to come. That's all. Whereas if you need liquidity after 6 months or 1 year, then if the situation turns worse from here, you won't even have the liquidity in the market today. You will not even be able to sell as easily as you can sell today, which is why you need to be cautious. I'm not being a bear if you take a 5-year horizon, but if you take a 1-year horizon, I would definitely want to exercise caution. And caution in times like this is always good, because you will err on the side of caution rather than on the side of over-optimism. Where we make mistakes in our judgment today matters more than ever before, and it is safer to err on the side of caution. I hope you think through your situation carefully, analyze your own stocks very diligently, judge what needs to be done in each of them, Evaluate your mutual funds very, very sharply and create liquidity where it is warranted, and avoid a situation where you will struggle for liquidity in the future when you need it. That's reason enough to stay cautious. Thank you for watching this video.